When you look at where our assets are, you see that, of course, South, Central and North America is well covered. You see that Eastern and Western Europe is well covered. Interesting areas in Africa, but where are the areas where we can extend?
Since we're so large, it is difficult for us to acquire any other company in the EU or in the United States. But we're seeing tremendous opportunities on a global basis. On the seamless mill in Saudi Arabia, we saw an opportunity. The Middle East is growing. We put two and two together, and you have a project which has excellent returns.
The Middle East is a fascinating area. It has two characteristics for a strong growth in steel demand. It has the population, and it has the money. It's an oil-rich region, and this manifests itself in huge infrastructure projects, sucking in steel from all over the world.
5-10 years ago, majority of the supply was coming from the West. Today, the supply in this market is coming predominantly from the East, from China, from India, to a lesser extent Turkey, and at the same time there is an increase in local production. And it's the only way, I think, indeed, to survive is that we are going to produce in the Middle East, and the plans to produce seamless pipes, they're publicly known. That is how we will position ourselves to produce here.
Africa, of course, is the lost continent of the world, and there's huge poverty. But there is a very large population, and at the end of the day, this population will require steel to improve their living standards.
We feel Africa has got a future. There are a number of countries in Africa that have good economic growth, albeit from a very low base. If you're not part of that initial growth, it's going to be difficult to come in at a later point.
We are the largest producer in Africa, largely through our operations in South Africa, and it's a very good base, I would say, for expansion in that region. The market is very interesting. We have already expanded in some neighboring countries. We are looking at more ambitious projects in other African countries.
We're very focused on growing in India. The market, we believe, is expected to grow at 7% per annum, and more interestingly, has high-quality iron ore. So you actually have the perfect setting for setting up a vertically integrated greenfield facility.
India being a democracy and a market-based economy, there is the possibility of making a direct investment. The huge markets of India in the future and China today don't have a strong Arcelor Mittal presence.
Beyond growth and value-creating synergy, the ultimate benefit of an M&A strategy is the industry consolidation. We consolidated the steel industry in Europe and the United States and forced a consolidation trend which is ongoing within the steel industry.
China is growing very strongly, but it's the one part of the world where consolidation is not occurring. And the reason for this is that there is a difference in emphasis and strategy between the central authorities in China, who see the need to create some world-class steel companies, and the regional branches of the Communist Party, who see it more in terms of the jobs and opportunities in individual parts of China.
The Chinese steel consumption will be more than 40% of the whole world. We are present in Hunan Valin, and Arcelor still is trying to make the acquisition of Laiwu.
The benefit that we can bring to China is technology and know-how.
One of the arguments for the acquisition of Laiwu was to bring in that know-how and, of course, to grow Laiwu through this.
Every steelmaker has asked itself how can they participate in China. It seems to be difficult, and therefore only Arcelor Mittal and to a lesser extent POSCO have made a really serious attempt to break into the market.
We want to ensure that we create value through M&A strategy, not just become bigger for the sake of becoming bigger. We are participating in 27 countries, so the visibility that we have in terms of M&A, there is no other industrial company in the metals and mining sector which has that.